Hello, and today we are discussing Illumina, ticker ILMN. Over the next few minutes, I'll discuss my thoughts about the valuation of this company and its business quality. This company has a market cap of $26.2 billion, enterprise value of $26.2 billion. So you see about no net debt on this business. That's always an exciting start for a look. They are in the life sciences, tools, and services industry. So they develop, manufacture, and market life science tools, integrated systems for large-scale analysis, genetic variation, and function. So it operates core Illumina and Grail segments. They have sequencing and array-based instruments and consumables, which include the reagents, flow cells, library preparation, genome sequencing kits. Okay, so that's really what they're doing. Is they're sequencing genomes. That's going to be DNA, RNA, and they sequence entire genomes of any size and complexity. They have resequencing kits. This is a very technical biology concept and would be very good use in research. You see genotyping, cancer diagnostics. This is going to be very high tech in the biotech space of what they're providing for that. So something to be aware of that kind of cages what they are doing as a business. Let's get down to the return on invested capital. You can see what looks like maybe startup type expenses. One thing to be aware of is, of course, genome sequencing is a relatively new technology. So it's not unheard of that they would be struggling to start up over this time period from 2000 to 2007. 1, 2, 3, 4, 5, 6 years of losses in a row. They made a profit in 2006, lost money in 2007. But it looks like since 2008, they have been profitable every year from 2008 to 2021. This would be a classic sign of a company that's struggling to start up. They start to reach scale. They hit scale in 2008, and then they just take off and get better since then. So you see 4%, 6%, 9%, 5, 7, 5, 13, 16, 14, 19, 16, 16, 10, 7. Now, if they hadn't had this massive loss in 2022, the story would probably look a lot different. I would be thinking, hey, this is a very high quality business. They're turning out to get better and better returns on invested capital. We're seeing a lot of double-digit returns. You're seeing high double-digit returns, 16, 19 type percents. These are very good results. But then you have a very bad year in 2022 where they did lose money again. So I'm thinking very differently about the losses in 2007 versus the loss in 2022. These are probably very different causes. Here you probably have a subscale company. Now you have a fully scaled company, but you still have massive loss. We're going to have to investigate as we go further. Otherwise, the numbers here look good. They're telling a story of a very high-quality business. 14% return on invested capital, 23% return on equity. These are very strong numbers. As long as you're over 10% here and 15% here for return on equity, I like what I'm seeing there. So again, high-quality business here. You're also getting very strong, very high growth. Revenue growth of 14.8%. Asset growth of 16%. I don't like that this number is higher than the revenue growth. If you're growing your assets higher than your revenue, you're going to see deteriorating returns. You do see that, of course, over the last decade. So, of course, now we have losing money, though, so we're not getting an EPS growth rate. We see a negative free cash flow growth rate because that number has gone negative. Something to be aware of with that setup. Now, this PE ratio here is negative. It's going to be really hard to tell what that is. We're going to have to do a deeper analysis. But you can see price to sales is not unheard of. Price to sales is 6. It's high, but it's not crazy. These numbers are all crazy. EV to EBITDA, EV to EBIT, but we can't really do a valuation based on these numbers without taking a deeper look in the other rest of the business. Now, what I want to see here is, let's go to this summary. We see revenue going from 1.4 billion to 4.5 billion. You can see it more than tripling over the course of a decade. That's a very good result. If you're tripling your revenue in a decade, that's very good. You can get very strong returns for yourself as a shareholder if you see that in the future. Now, you see that they had a down year in 2020, really strong in 2021, and then they just had slow growth in 2022. But of course, you average the last few years, you still get very good returns on that growth. Now, let's look at our gross profit. Our gross profit is going from 900 million to 2.9 billion. So you've tripled your gross profit as well in the decade. That's a good number. Operating profit has not done as well. You had an operating loss in 2021, but you had a positive net income, and then you had a positive operating profit in 2022, but negative net income. So this is probably a non-operating expense. So we can probably ignore this, but we need to understand, this is write-offs. What's going on here? This is a massive loss. 28 cents of losses on a per share basis is quite significant when that's basically going to wipe out, 4 to 5 years of profits before then. But what I want to think about is like, okay, let's ignore this 2022 number and let's kind of like average the last few years. So peak earnings, $6.74. You have a lot of earnings in the $5 range. Maybe we just say earnings is $5 a share. If we said it was $5 a share, then you're going to be 33 times earnings. So this company is massively priced. PE of 33 on an average, of $5 a share over the last few years. You're going to easily say, hey, this is pretty expensive. Even if you did a price of $6.74, you took the peak earnings, it's still trading at a very significant price compared to peak earnings. Something that I would be aware of and maybe a little concerned that I'm paying a very high price. Now, why are you paying a high price? You're growing rapidly. You have pretty strong core returns on equity and returns on invested capital. It's not unheard of for large companies that are growing rapidly, have good returns to trade at these expensive prices, but it's a little higher than I'd want to see. For me, although this is a high quality business, I like to buy high quality business at PEs of 20 or less. And we're really not seeing that here. So a PE of 20 on our, if we're saying earnings power of $5, is maybe a stock price of $100 or less is where this could start to get interesting. Could still be on track for watch list type business because you're seeing very strong returns here, but you had deteriorating results in the last 2 years, which is going to make it very difficult to make that assessment. However, we can look at the financial statements to discover a little bit more. If you enjoyed this video, hit the like button. Don't forget to subscribe. Let's go to the income statement now. So we can see that our cost of goods sold has gone up a pretty decent amount over the last few years. So although your revenue has continued to grow, it's caused a deteriorating gross profit line. In addition, you have SG&A still growing pretty significantly over that time frame. R&D up, basically doubling. And so that's really wiped out your operating profit because your total operating expenses, they did double from 2020 to 2021. So you had that operating loss. They were able to cut some of their expenses, but they still had, $1 billion of higher expenses in 2022 than they did in 2021 or than 2020, which caused massive problems here on the operating profit line. And you can see total operating expenses basically matching gross profit now. So you're not earning anything on that basis now in the 2012 months. We do see what happened here is other non-operating income. Now, that's not going to tell us too much on what we can expect going forward. What really matters, of course, is your operating profits. But so I'm not going to punish them too severely for this, 2022 number. This could be write-offs. This could be any number of things. But I don't like seeing, $4.6 billion in losses on a bit, that's representing 20 to 25% of the overall enterprise value of this business. That's a lot of money to lose in a single year, even if it's a non-operating loss. You also need to be skeptical about non-operating losses. Those are not a good sign, even though they're not operating losses. So just something to be aware of. They do have some operating gains in some years. So that's going to cause some of the volatility in the numbers that we saw. These big spikes are not necessarily reliable because you have these non-operating gains. It is what allowed them to, despite having an operating loss in 2021, they're able to recover there with this big non-operating income. So just something to be aware of. You can't take credit for the non-operating income in the good years and ignore it in the bad years. You have to kind of do it both ways. Either way, you do have a year here where they're having losses in the last decade. Not a great sign. But what's more concerning to me is this deterioration in the business. This 2020 number where you had $1 billion in cost of goods sold, and then your cost of goods sold are up 60%, and your revenue is not. That's a big concern. It's causing a problem in your ability to manage this business. 2021, you can see they've declined their gross profit, and that's really caused major problems because their operating expenses are still up. So it's really a big problem for how they're managing this business. Shares outstanding run from 140 million to 157 million, so you're up about 10% over the course of a decade. That's going to add about a 1% dilution rate to your overall results, reduce your EPS by 1% per year. Let's go to our balance sheet. Let's see, total current assets are down. Cash is down. Short-term investments is down. PP&E. So PP&E is up 10x from 166 million to 1.7 billion. That's a massive increase. Goodwill is up a lot. So it looks like they made some sort of acquisition here in 2020, 2021. You see the 7 billion in goodwill. And then that goodwill has been no longer there in 2022. So they wrote off a bunch of it. So the problem is look, they just made this acquisition and then you have a big write-off. So, I mean, this is what this is clearly attaching to. You can relate the financial statements to understand what's going on. So you have a $4.6 billion write-off a year or two right after you make a huge acquisition for the size of this business. So you basically are admitting you made a massive mistake. The problem is when you make a massive mistake, unless there's been a change in management, how do I have confidence that you're not going to make another massive mistake in the future? I mean, you acquired almost $9 billion in goodwill and intangibles, on a business that is market cap of $26 billion. I mean, that's a huge acquisition, and yet you've already written off a significant chunk of it, maybe half the acquisition over that time period. It's a big concern. Long-term debt doubled $800 million to $1.4 billion. Not a big deal for the size of the business. Again, they have cash to offset that. Let's see. Go to the cash flow statement. So you can see they paid $2.4 billion for the acquisition here. Might have issued some shares. It's not totally clear there, though. They probably issued shares. Where's what happened to the share count? Did we see a jump? We saw a little bit of a jump. So they might have issued some shares there. PP&E, pretty stable. But they're doing pretty strong investments. I mean, you think about like the PP&E, or these investments are a good chunk of the net income. But of course, they're growing quickly, so that's not a big problem. You have very high stock-based compensation, extremely high stock-based compensation. $754 million in stock-based comp, $366 million in stock-based comp, $200 million in stock-based comp. Against your net income numbers, that's a lot of stock-based compensation. So it brings into question, how reliable some of my cash flow numbers are, because I'm basically avoiding paying my employees directly in cash by giving them stock-based compensation. It's not unheard of for biotech type focused companies, tech type companies. I just don't like to see it. It's not a green flag for me. For me, it's a red flag if stock-based compensation is too high relative to income. And that is what I see here. So overall, Illumina is a company that I've been aware of for a little bit of time. It's always been something that's very interesting to me. I think this genomic sequencing is a very good growth industry for the future, and I believe Illumina is one of the world leaders in it. That explains some of their revenue growth. We're likely to see more and more genomic sequencing in the future, and I expect it to continue to grow. They've been able to triple their revenue in a decade, and they're probably going to continue growing if my understanding of their business is accurate. However, I have a lot of concerns about the recent capital allocation, and that would be a problem for me as a potential shareholder, as I need to understand why they made this bag acquisition. Was it necessary? Why did they then have to write it off so quickly thereafter? They basically said they overpaid by like $4.6 billion. That's a huge chunk of money to overpay in a business that doesn't even make $1 billion in profits in a single year. So you're basically saying you overpaid for, multiple years worth of your net income, and that's a major concern into what the management's going to do in the future. If there's a management change, maybe it gets more interesting. I'm a little disappointed because I thought Illumina would hit my watch list, but this big loss here from that acquisition, and then some of the deteriorating results over the last few years in terms of the cost of goods sold going up so quickly, and their inability to maintain their revenues despite that is a big problem for me as a potential shareholder. I don't like buying businesses that are actively deteriorating when I'm buying them. I want to see businesses that have either stabilized or are improving, and I'm not seeing that here with Illumina. So for that reason, I'm going to pass, but I think it's a very interesting business, and I think you could probably learn a lot from doing more research on this company, so I hope you'll check it out. Thank you for listening, and until next time, stop paying fees, start building wealth. Hit that like button. Don't forget to subscribe. You can check out my affiliate link to quickfs.net. This is the tool I'm using to show you this analysis. Is in the first link in the description below. You can get a free or paid account there and do analysis on every company in the S&P 500 in 10 minutes or less. Thank you for listening. Until next time.